Hello everyone, welcome to my lecture on Unit 4 Topic 9 Adjustments made in the final accounts or financial statements. The trial balance presented for preparation of final accounts is not the final one. There could be some pending items which could call for certain adjustments to different accounts, because from this trial balance only we'll be preparing the financial statements, that is the trading account, P&L account, as well as the balance sheet. So the necessary adjustment entries need to be incorporated at the close of the year when the final accounts of a firm are being finalized, in order to make your financial statements more accurately reflect your income and expenses. So the most common adjustments will be coming across while preparing your final accounts would be accrued items, prepaid items or payment made in advance, depreciation, closing stock, as well as a balance date, bad debts, and provision for creating bad debts. So if adjustment entries are not made, firms' incomes and expenses do not match up correctly and may not be possible for providing reliable and transparent financial information to the stakeholders. So all the adjustment given at the end of the trial balance will be recorded twice. That means it will be having a twofold effect. For every adjustment there will be twofold effect. One is, once it will be appearing in the trading and profit and loss account, trading or profit and loss account, another adjustment, another time it will be appearing in the balance sheet for the same amount. So we'll proceed with understanding how this adjustment will be made when given. First one, accrual expenses, outstanding or unpaid expenses. An accrued expenses indicates that an expenses that have been incurred but not yet due for payment. In case of outstanding expenses, it must be added to the concerned account in trading and profit and loss account. Again, this item should be shown in the balance sheet as a liability. So here it's shown here. Suppose the salaries are outstanding, that is an adjustment given to us. So how is that it should be treated is that outstanding amount or accrued expenses, salaries is an expense, right? This outstanding expense which is supposed to be paid by the firm but not yet paid, will be added to first, thereby increasing the total amount of salaries, right? So this is the total amount of the salary that is to be paid. And again that same outstanding expenses will be shown on the liabilities side as the outstanding expenses, to that extent how much it is standing, how much ever it is outstanding, right? So this is the twofold effect, that is once adding to the concerned account, and again listing it under the liabilities of the liabilities side of the balance sheet. The next adjustment is prepaid or unexpired expenses that are nothing but paid in advance. So expenses that are charged in the future or simply the future expenses and that are paid in advance are known as a prepaid expenses. So once that is prepaid or the ones that are advanced, it doesn't belong, or the revenue is not belonging to that particular year in which the financial statements are prepared. So that extent the adjustment are to be done, right, to give a clear picture of the revenue as well as the income and the expenses. So in case of any expense is prepaid, it must be deducted from the concerned head in trading and profit and loss account. Trading or profit and loss account, again and again it should be shown in the balance sheet asset side. So let us assume here this is the adjustment given to you, right? So rent is given as 10,000. So how much is prepaid? So prepaid amount is 3,000 is amount prepaid. So you are supposed to deduct, you will be deducting from the rent paid, that is the rent which is being paid advance, and the net payment of rent for that particular year is arrived at. So the whatever amount is paid in advance or prepaid, again it will be reflected in the balance sheet as a prepaid rent. That is how the adjustment is done for the unexpired expenses or payments made in advance items. Next one is provision for depreciation, right? Depreciation refers to the reduction in the value of the asset. It can be due to wear and tear of the asset, passage of time, technological developments, and outdatedness, right? So fixed assets are subjected to depreciation. But generally depreciation is charged as a percentage on the value of the fixed assets per annum. If depreciation is given as an adjustment, it should be charged to the profit and loss account on the debit side, and again it should be deducted from the concerned asset on the asset side of the balance sheet. If suppose in some cases, if you are supposed to find out the depreciation for the asset, this is the formula given, that is depreciation is equal to cost of the asset minus scrap divided by the number of years or the lifespan of the particular number of years of life of that particular asset. Now here is one example for given to you how to make an adjustment pertaining to depreciation, right? So this is a asset in the balance sheet, furniture. So you are supposed to depreciate this furniture by 1,000 rupees. In some cases it will be the amount, or in some cases it will be percentage on the value of the asset, whatever it is, right? So this 1,000 has to be deducted from the asset value of the asset, and this will be the end of the year. This will be the value of the asset now. It will be not 10,000, rather it will be 9,000, right? So the same 1,000 depreciated amount will be shown on the asset side, on the debit side of the P&L account. That is debit side, and this is the credit side of the P&L account. So this is how the depreciation on any asset will be, adjustment will be made. Coming to the closing stock or inventory. Closing stock will neither be added to any of the account or neither deducted from any of the account. Rather, it will be included. If closing stock is given as an adjustment, it will be entered on the credit side of the trading account, credit side, debit side, right? This is a trading account, so it will be entered on the debit side, credit side of the trading account, and another entry would be another entry would be on the asset side of the balance sheet here, right? Next, writing of bad debts and provision for bad and doubtful debts. A bad debt is a debt which is irrecoverable, and hence it will be written off as a loss. At the time of preparation of the balance sheet, some debt might have become bad and they will be written off as a bad debts, and there is a certainty regarding that loss. When bad debt is given to you as an adjustment, basically this will be done with respect to the debtors. So the adjustment will be done to the sundry debtors. Sundry debtors are those from whom the payment is supposed to be received by the firm. So from here, when you are asked to provide for bad debts 2,000, that means you are supposed to receive 10,000 from the outsider. Now 2,000 is assumed to be bad debt, that is, there is no chance of recovering 2,000 rupees. So the possible amount of recovery will be 10,000 minus 2,000, that is your 8,000 rupees. So that is how the adjustment will be made pertaining to bad debts. Now the same bad debt amount, that is 2,000, will be again written or again entered on the debit side of the P&L account. If suppose already bad debts are standing over here 5,000, to that another 2,000 will be added, and together the total amount that the firm is sure that it is not going to recover, and that is it's considering it as a loss for the firm. So the bad debts total will be here 7,000. Right? This is one case of making an adjustment pertaining to the bad debts. And another thing is when you are asked to provide certain percentage of provision for bad debts, bad and doubtful debts. Create a provision for bad and doubtful debts. So on these data, you will be asked to create certain percentage or certain provision for doubtful debts. Now it is given as 3,000, or it may be assuming to be 5%. So the total amount of the debtors at the end of the financial year is 60,000. 60,000 minus 5%, that is 3,000, is nothing but your 57,000 is the total sundry debtors amount, that is the amount that is supposed to be realized from the outsiders, from the debtors. So the same provision what you have created, that is 5%, again will be reflected in the P&L account. P&L account on the profit and loss account on the debit side as a expenditure or a loss for the company. Right? Now in some cases you will be asked to create two adjustments will be given simultaneous, that is bad debts. Let us assume that it is 5,000 is a bad debts. So as we know, this is sundry debtors are 50,000, right? Now again you are supposed to create provision create a provision 5% on, right? So how this both adjustments have to be incorporated here is from 50,000 data. First you deduct the bad debts amount, that is 5,000. So your outstanding debtors would be 45,000, on which you are supposed to create this provision at the rate 5%. So the final amount will be your sundry debtors. So whatever the amount it is 5%, you are supposed to that same amount has to be entered on this debit side of the P&L account, and the relevant adjustments are to be done to the sundry debtors. This is how this thing will be done. So here when we talk about the 5%, it will be 2250. So the final amount, whatever the balance is there, will be your total sundry debtors. It may be mounting to 42,750, somewhere around, right? Now this is how the adjustments pertaining to the outstanding expenses, prepaid expenses, closing stock, bad debts will be made while preparing the financial statements. With this, I'll end up the session here. Thank you.